So right now, it's clear that we're in one of the better parts of the cycle. Corporate distress levels are at record lows and have been at low points for the last couple of years. There aren't obvious signs that we are about to head into the crisis, but any fund investor, anyone managing a fund over the next 5 years, has to take into account the possibility, indeed the likelihood, that we will see some form of stress event. It's now more than ever essential that we think about creating all-weather portfolios that will be good in the best of times and good in the worst of times. I think when you see rising corporate distress levels, when you see spreads tightening, those are the most obvious kind of macro indicators to look for to see the first signs of distress. But as a fund investor who has the privilege of having been able to speak to hundreds of investors and GPs representing thousands of underlying companies, often I find most useful actually listening to those GPs about what they're seeing in the market in the here and now. At the moment, we see people worrying about the future, but fewer signs of actual distress in the portfolios that people are managing. Which means that for the very short period we feel okay about the situation, but things can change very quickly. I think in any market environment you are going to see distressed opportunities because there's always the level of idiosyncratic risk and idiosyncratic problems with companies that can be dealt with by debt investors in the distress space who know how to go and help companies manage through those crises. However, it's also the case that many of the GPs that we speak to operating in these spaces recognize and say that distressed opportunities are probably harder to find than they are at other points in the cycle. What we therefore look for is people who have the network, the relationships to be able to find enough opportunities during this point in the cycle, and yet also have the discipline to work through situations here without investing in things which end up looking very risky if the cycle turns, and yet get outsized returns if and when the real distressed opportunity were to arrive. I think over the last couple of years we've seen a massive growth in the private credit space. And that's not only been in volume terms, but it's also been in terms of the diversity, the complexity, and the sophistication of strategies which are out there in the market. What we think of as being the next rising stars are those strategies which really deal with, which are really on the cutting edge of that kind of innovation, where you're getting compensated not only for taking risk, but for the complexity, the skill set that the managers are dealing with. And there are a number of growing strategies now. We see increasing numbers of strategies where people are providing more complicated forms of structured financing. We've seen growth in areas like high growth lending, an area which is already very large in the US, but probably undercapitalized in Europe. And there'll be many more other examples of situations where people in the private credit space are doing something new and interesting, often in spaces which banks have left behind, or to deal with situations which are new in a constantly evolving investment environment.